Hello and welcome to another episode of Darwin Investors. Finally, we had a good week last week, first one in a while. For me, in large part, it was due to my USOI holding that was actually suggested in the comment section by one of the viewers here. So that got me thinking maybe I go through the comment section and then I will look at different viewer comments and then make a video over the equities that people are suggesting in the comments, because maybe there's some more gems in there. Maybe we can make some more money, or maybe I can make some more money. And it did seem that a lot of these equities had a couple things in common. One, they were really high yielding equities. And the second thing is they tend to cost less than $50 a share. So that's what we're going to be looking at today. Today, we're going to dissect 7 high dividend yielding equities under $50 a share suggested by you, the viewer. And by the way, thanks for checking out this channel. I never actually thought it would grow to the size that it has. I know it's a small channel, but I never even thought it would get it would get this big. And I definitely never thought I would post this regularly. I figured out ways to kind of like make videos throughout the weekend. I can get out and do something and come back and record and that sort of thing. So it does seem to be something that I should be able to carry on doing. The suggestions that we're going to look at this week, I had some suggestions from ISS Tech. His suggestions were PAA, WES, and AMLP. And then Dave suggested WMB because they entered into a partnership with Chevron. Oromar's suggestions were EAD and DIV. And then finally, Chad suggested me through my text message, because I know his mom, Main Street Capital. So we're going to go ahead and go through these and just kind of see, is there something in there that maybe we should be considering investing in? And then after that, we're going to be looking at my portfolio and how I did last week and how that USOI investment is going. Plus, I opened up a whole lot of options. So there's a lot to cover. So let's go ahead and get into this. So I went ahead and put together just a small presentation here with all the ticker symbols that were suggested to me, and I ordered them in by cost per share from least expensive to most expensive. I put in their investment types, what sectors they're a part of, their dividend yield, how often they pay the yield, whether it's monthly or quarterly, and the ex-dividend date. Remember, if you are going to try and take advantage of some of these dividend yields, you got to get it in at 1 business day before the ex-dividend date. So if it's the 10th of March and that's a Tuesday, actually that one's a Friday. I know that for sure because that's when some of my options expire. So that one's a Friday. That means you would have to have this in by Thursday in order to capitalize on the dividend paid out by this ticker symbol EAD. And also understand that on the day before this ex-dividend date, you would expect that the price per share will go up, and then on X date, the price per share will decline by the amount that they're paying for their dividend. Now, in the case of EAD, it pays about a nickel a share. You probably won't notice it much. But in the case of something like USOI that pays $3.33, you will notice that one. So let's go ahead and look at EAD. So I got 2 different results here, it seems, for this EAD. They both are alluding to the same exact equity. However, one's called the Wells Fargo Advantage Income Opportunities Fund Common Stock, and the one over here on Schwab calls it the Allspring Income Opportunities Fund. You can see that this one's $6.68, as is this one, so they're alluding to the same exact equity. This is a high-yield corporate bond ETF. Morningstar seems to like it. It's rated 4 out of 5 stars in the long term and the short run. This past year, it's down 14.8%. Not a big deal. A lot of things are down about that. Last 3 years, it's down 1.33%. And last 5 years, it's down 17.43%. And some of these years were really nice. So this seems to be a bit of a depreciating equity. It does pay a distribution rate annually of 10.07%. It distributes the dividend monthly, and the next X date is going to be the 10th of March. So if you're interested in this, get your money in by the 9th of March, and it looks like the next dividend payment is going to be 5 cents. And that makes sense because if you look at their history here, it's always 5 cents. So it's pretty consistent here. That was 6 cents, and back here would have been 6 cents. So it seems like the cost of their dividend does seem somewhat dependent on the price of the share price. The lower it goes, the lower the dividend goes. Its holdings include Enviva, Sabre, Occidental Petroleum. That one surprises me. I didn't realize that that would be considered a junk grade bond, but yeah, I guess it's considered a high yield corporate bond. GOCCM, Allspring, Enact, Pattern, and Fly Leasing. The top 10 holdings is 12%. So it's got a lot of holdings. I can't expand it and see any more, but if the top 10 or 12%, you'd figure this has about 90 holdings in it. The next one on this list is going to be PAA. That is the Plains All American Pipeline. This was a pretty interesting one. This looks like a nice buy and hold. It's an oil and gas stock. It's trading for $13.41. Over the past year, PAA has been up about 23%. Over the past 5 years, of course, it's down 40% because this happened to a lot of these oil equities when oil went negative. But under normal circumstances, this does look like it's been kind of a monster. Not only are you getting the underlying share appreciation there, but you're also picking up this nice dividend yield here of 7.98, let's call it 8%. It's paid out quarterly. The last time it went X was January 30th, so you would expect the next time it would go X would be the end of April. Its last dividend payment was 27 cents a share. The price to earnings ratio of this is 11.27 with a forward PE of 9.92, indicating that they are expecting revenue growth and earnings growth over the next year. It does have a Morningstar rating of 3 and a Morningstar report. Let's have a look at that. So Morningstar has a fair value estimate of this particular stock of $14. It was currently sitting at $13.15 at the time of this print. What they are a pipeline company, just as it says in their title of what the company is, Plains Pipeline. They operate within the Permian Basin. The reason why they're able to grow over the past year is that oil export demand is the growth engine here. They are sending a lot of stuff off to be shipped elsewhere. As the United States becomes more of an oil exporter than it has been in the past, we're seeing a lot more oil exports, and perhaps that's what's making this such an attractive stock over the past year. So long as that's the case, I would expect that this particular stock is going to appreciate in value. But when we stop exporting so much, I would expect that the price of this stock will come back more into line where it has traded at traditionally. Now, after the bulls say that after several years of difficult decision, Plains is finally in position to return more capital to Plains shareholders. The Onyx joint venture is expected to result in about $50 million to $100 million in capital. Plains has done well with buying back $300 million in stock, so they are returning money to shareholders in the form of dividends and in the form of buybacks. The bears are saying that lower natural gas liquids pricing is expected to contribute to a decline in the bottom line of $100 million. The other ones like it might be Energy Transfer. I actually did a video on this one months ago when it was $11 a share. Now it's roughly $13 a share, saying that this was a nice undervalued equity. The bears also say that Plains Cushing oil storage is less valuable in this environment. Obviously, you don't need to store as much if you're shipping it all away. And also, the bears also say we don't know the impact of the other basins' volume growth. We don't know what they're growing like. We know that the Permian Basin is growing, but they don't know if their others are and if they're going to use these pipelines. So these are the positives and negatives of PAA. Overall, I think this is a really interesting buy and hold. And so long as we are an oil exporter, oil and gas too. Natural gas seems to be a big revenue producer for this particular pipeline. The next one on this list is going to be the Western Midstream Partners stock. It's also an oil and gas stock. It trades for $27.01. If you look over here and see the past year, it's been up about 8.78%. Over the past 5 years, it's down 23%, but since the low here, it's up 713% in the past couple of years. So if you're lucky enough to buy it down there, you've basically probably not watching this channel because you don't have internet yet on your private island. But what they are is they are also an oil and gas pipeline stock similar to PAA. They operate, it looks like, out of the Delaware Basin in West Texas and New Mexico, and the DJ Basin in Colorado. So these would be competitors to PAA, as it appears. Let's look up a little bit more on the numbers about Western Midstream Partners. Their price to share ratio is 8, well, let's call it 9, and their 4P is 9. So their growth is supposed to be relatively flat over the next year. They do pay out a quarterly dividend. The annual dividend rate is 7.4%. Their last X date was January 31st. So much like PAA, they should pay out their next quarterly dividend at the end of April. Their last dividend was 50 cents a share. There is no Morningstar report for this one, but we can look at their financials a little bit and just determine, how they're looking. So, 2021 they had $2.4 billion in revenue. 2022 was 2.6. Operating expenses seemed gone up, kind of the same as their revenue has gone up. Their net income has gone from 943 million to 1.25 billion. Their net income per share is gone from $2.18 a share to $3.01 a share. You can see the number of shares has gone down from 2021 to 2022. So they are also returning money to the shareholders in the form of dividends, as well as in the form of buybacks, and their stock appreciation has been just astronomical. So, but I wouldn't expect to see that kind of performance out of this stock in the future, but it does look like it's going to be another good one, just like PAA, to hold on to, so long as we're exporting a lot of oil and natural gas. It's probably going to work exactly the same way as PAA. The next one on the list here is going to be WMB. WMB is Williams Companies. It's another oil and gas stock. It's currently trading for $30.97 a share. Over the past year, it looks like it's been down about 7.28%. Over the past 5 years, this one has actually been up 10.61%, even with oil going to zero. Its price to earnings ratio is a little bit expensive and elevated for an oil and gas stock. It's sitting here at 18.5 with a 4P of 18. You would think that if it's going to be this elevated, that next year this might be like 9 or 10. It's growing like a weed, but that doesn't appear to be the case. It does pay out a quarterly dividend. The annual yield is 5.78%. The next X date is March 10th. So if you want to get in on this and get that 45 cents, have your money in by March 9th. This one does have a Morningstar report. It's sitting here. Morningstar says it's rated 3 stars out of 5. When we look at the Morningstar report, we can see that that the fair value estimate by Morningstar at the time of this print, which was the 24th of February, is $32. It's currently trading under that. So Morningstar thinks that this is a very safe stock at this price. It's well positioned to benefit from the boom in U.S. LNG exports. Okay, so this is another oil and gas exporter, just like WES was and just like PAA. Most of Williams' growth will continue to be directed towards its Transco pipeline, which runs from the Gulf Coast to the northeast. Transco links low-cost gas supply in the Gulf Coast and Marcellus Shale to high demand for retail use. LNG exports, gas power generation, and increasing industrial gas. So again, this is along the same story as the other. So long as we're net exporters of natural gas and oil, and then that just keeps continue trending upwards. These are the types of stocks that are going to continue to do well. However, you would expect that as things go back to the way that they used to be, if they ever do, hopefully they do, then these types of stocks might actually see a little bit of a pullback. And so we won't go into all this. I imagine it's going to stay the same as PAA and WES. Now, Dave did mention that they entered into a partnership with Chevron. So when we look for Chevron here, it says that Williams has tripled Hayesville gathering volumes since 2021, is connecting this growth to the market via the LEG expansion, and added additional value via a Chevron acreage dedication for more gathering volumes. And maybe that's why people are kind of high on this one and willing to pay a little bit more, is because of this partnership with Chevron. But again, it does seem to be like, to me, it kind of has the risk of actually pulling back in share price, because it is quite expensive relative to the price of other equities of this sort. All right, so the next one on this list is going to be AMLP. AMLP is the Illyrian MLP ETF. It's basically an energy limited partnership ETF. It's currently trading right now for $39.68 a share. Morningstar has it rated below average over the next 3 years, 5 years, and 10 years. Over the past year, it is up 4.2%. Over the past 3 years, it's up 88.5%. So it's been a really good performer over the past 3 years, has this ETF. Its dividend payment, its distribution yield is 7.69% a year. It's distributed quarterly. Its last X date was February 9th, so we would expect the next X date to be sometime in the beginning of May. Its last dividend payment was 77 cents, and it has the energy holdings. It looks like it's more pipelines. It looks like some of these we've already talked about. It's PAA, it's Energy Transfer, it's WES. I'm guessing WMB will be in there somewhere. Maybe this is 91% of their holdings. They don't seem to have too many holdings. Let's see what else is on this list here. New Star Energy, I was going to feature that one, but not enough to do them all. But again, these are all oil and pipeline stocks are doing really well right now, so long as the United States is exporting lots and lots of oil and gas. The last one on this list is right here. This one is the Main Street Capital stock. This is now we're going to be talking about the financial markets or the capital markets, and this one's trading for $42.27 a share. Over the past year, it's been basically flat. Over the past 3 years, it's been basically flat. So what you're getting out of this one is basically the dividend for this stock. Right now, the price to earnings ratio on this is 13.15 with a forward PE of 10.91. So it trades a little bit rich for a financial stock, but not crazy rich for a financial stock, and it is expected to grow. It does pay a monthly dividend. The next X date is March 7th, so you would have had to have your money in by tomorrow. If you have it in by tomorrow, you can collect this dividend. Looks like the dividend is 23 cents a share. The annual dividend rate is 6.39%. There is no Morningstar report for this particular company, but we can look and see what they are and what they do. So if we go to their About page, we can see that what they are is they're an investment firm that primarily provides long-term debt and equity capital to lower and middle market companies and debt capital to middle market companies. So they're basically a lender for small and medium-sized business. Main Street's private loan and middle market debt investments are made in businesses that are generally larger in size than its lower middle market portfolio companies. And so it does give out private loans to slightly larger businesses. And here in a raising rate environment, I'm not so sure this is kind of risky, but according to Schwab, they should be growing in size over the next year or so. If we look at it here, their net income does steadily increase. They went from 2.4 million to 6.2 million to 9.3 million, and this is their net income. This isn't their revenue. And so they are a growing company. So far, people don't seem to be defaulting in the United States. It doesn't seem on their high yield debt at the moment. People are taking out a lot more credit, but they're paying their bills. They have jobs. And so businesses seem to be doing well. I mean, this recession that we're having seems to be kind of unique to those of us in the financial markets, the people in the internet. If you go to your children's softball games or whatever, baseball games or whatever, and talk to people in the stands, they would have no idea that we're in some horrible recession right now, or at least we have been. And to be fair, the markets have been trading basically sideways since last May, so it really hasn't been that bad. Now, a lot of these are the oil and gas stocks. So I did want to kind of mention one thing here. This is what Chevron, they had their investor day last Monday or Tuesday, one of those early in the week. And what they did was, it's supposed to be sort of like a pep rally for Chevron, and their stock actually went way down right after this. And I'm like, what on earth did you guys say to make the stock actually go down like that? Well, the only thing that I could come up with here was that it said that Chevron expects that by 2025, the price per barrel is going to be between $50 and $70. And that's good news for those of us filling up our gas tanks and what have you. But Chevron is kind of budgeting for this as their projected long-term price per barrel. So I would just caution those of us that are in these stocks and collecting our money now to know that at some point the party will be over and it will go back to normal. So when you look at Chevron, the price of oil traditionally, they're saying it's going to go between here and there. It's not going to like have these big spikes, but right now it's sitting about 79. It seems like a pretty fair place to buy stocks like Chevron and even hold them for a little while. But just understand that at some point the party will probably end, but not before. I don't think that before it goes up a little bit more in the near future. All right, now let's go ahead and look at some of the trades that I have open this week and some of my holdings. So right now you see I got the USOI. I'm currently down $782 on that position. However, I did make about $2,150 in dividends. So if I was to sell this now, I would be up about $1,400. I would consider this a winner. I really like that. Now of my calls and puts that I have open this week, you see that I've sold all these. That's why it's a minus sign. If I bought, there would be no minus sign there. I sold a put on Chevron that expires on the 10th. If Chevron is above $157.50 by the 10th of March, then I will get to keep someone's $122 and I don't buy any shares of Chevron. I'm currently up $102 on that position. I'm probably just going to close it out on Monday, and I'll resell another put should Chevron take another deep dive down on that day. I've got covered calls on ConocoPhillips. I got a covered call on Chevron. Because I have a call on it and a put, you would call this a strangle. I have strangled Chevron. So what this says is if it finishes above $170, I will sell all my shares of Chevron for $170 a piece if it finishes above $170 by the 17th of March. In order for someone to give that contract to me, they paid me $79.35. I'm currently down on that contract because Chevron has gone up. The closer Chevron gets to $170, the less this contract is worth to me and the more it's worth to the buyer of this contract. I also sold a call on Phillips 66. I have sold a put on Advance Auto Parts. This is kind of like an ATM machine for me as Advance Auto Parts. I get basically if Advance Auto Parts finishes below $138 by the 10th of March, I'm on the hook to buy 100 shares of Advance Auto Parts for $138 a share. But should it finish above $138 a share, I would get to keep their $204, and I'm not going to be buying any shares of Advance Auto Parts. Now, understand that someone paid me $204 for this. So what this means is that my break even for Advance Auto Parts is $135.95. And as this approaches expiration, you got extrinsic value and intrinsic value on your options. So as the extrinsic value gets diluted away, all you're left with is the cost of the share versus the value of the contract. So let's say that this is sitting at Advance Auto Parts is $137 on the morning of the 10th. Well, then this contract would probably be worth about $135, we'll say. I would buy it back for $135 and I still net $70, even though the price of Advance Auto Parts is below $138. Now that might seem a little bit confusing. I might do another video about that sometime in the future, but just know that even if this finishes below $138, because I was given so much money to hold this contract, that I can still make money even if I sell this contract back and Advance Auto Parts is below $138, provided it's not too far below $138. Same thing for Marathon Petroleum. I went ahead and I sold a covered call in the money on this one because I think 131 is really fair. And I actually sold it in the money, meaning this was $132 when I sold it, but I sold a covered call with a strike price of $131 that expires in 2 weeks because I think Marathon Petroleum will pull back and I will get to keep a lot of this money. Now my break even for this one is going to be $134.54. So like I said, same applies to this, but in reverse. If Marathon Petroleum is trading at, say, $133 on the 17th of March, this contract is still only worth the intrinsic value of that, which would be $200 because you've gotten rid of all the volatility and all of the time. So I could buy this back for $200, still make $154 and keep all my shares of Marathon Petroleum. If it gets screaming way higher, then I'm not going to buy this back. I could roll it, but I might not. I don't know. I might just take the money because it's a lot of money, and I think I'll just hold on to it. I'll just hold on the money that they're going to give me. All right, so I want to thank everybody for checking out this channel and leaving these comments. I do read them all. Thanks for leaving these suggestions, and if there's anything you want me to cover, just leave it down there. I read them all. I'll go ahead and cover some of them. But other than that, if you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye.